this, the International Association of Insurance Supervisors has a set of core principles, and two of those are going to be important to today's discussion. The first is core principle 7 on corporate governance, which calls for a framework that allows for effective management and oversight of the business. And so really that takes into account not only the business objectives, but it needs to take into account the risk aspects of the business and how to best protect the business and the interest of policyholders. Principle 8 regarding risk management and internal controls is seen as being a part of the corporate governance framework, and in fact I would say as an integral part. Edgar, tell us a bit about Aegon's approach to these in terms of these two principles.
Yeah, Aegon has a board of directors consisting of one executive member, the CEO, and apart from that only non-executive members. And Aegon also has an executive committee. So the board is accountable for ensuring that these principles are adhered to. And the executive committee contains of executives who are responsible for implementing these systems of risk management and internal controls. And they allocate the necessary resources and provide support for risk and internal control related matters.
Great. So when we think about this notion of risk appetite, we need to think about it as something into itself, but also in the context of risk tolerance and how is it different? Excuse me. The Institute of Risk Management defines risk appetite as the amount and type of risk that an organization is willing to take in order to meet its strategic objectives, whereas risk tolerance is about what an organization can actually cope with. And I think it's important here to note that risk is part of business, and some risk needs to be taken in order to achieve strategic objectives. In other words, what risks is the business willing to undertake, and risk tolerance is really asking the question about how much. So I think, you know, a lot of folks, particularly in the sanctions space, think about risk in the context of strict liability, and we don't want to accept any sanctions risk. That's really kind of an insurmountable situation to put oneself in, because in any sort of context, there's going to be risk, and we have to make sure that we have identified that risk is there, and that we have the infrastructure in place to deal with that risk. And so I think that's the important thing to be thinking about in terms of risk appetite and risk tolerance. So what are the key principles for risk appetite? And when thinking about this, we need to think about some of the key principles. And the Institute of Risk Management has provided some here. First, there's the fact that risk appetite is a complex concept, and you need to acknowledge that and not fall for an overly simplistic view. And that gets back to you know, the situation I just mentioned with respect to sanctions and zero tolerance for any sort of risk in that area. I think that's an insurmountable situation. Second, when considering risk appetite, one needs to be thinking about key risk indicators and key performance indicators and their importance. There's also a need to address the need for good quality data to support the KRIs and KPIs. That is part of an overall data governance framework. Third, risk appetite is not a single or fixed concept. It will vary over different risks. Fourth, one's appetite for risk must be considered in the context of the maturity and capabilities within the risk management framework. That gets back to sort of considering this risk tolerance. You may not have a high tolerance for risk if your risk management capabilities, such as your internal control framework, are not sufficient to mitigate that risk. Fifth, risk appetite spans strategic, tactical, and operational levels, and it should be considered throughout the organization. And finally, sixth, the risk appetite cannot be considered outside of the control culture of the organization. So a risk appetite statement should have some key components. It should set forth the definition of the risk. It should set forth enough risk to achieve desired results. This gets back to that notion of balance that I talked about. There's always some degree of risk that's undertaken in the business activities. Demonstrate an understanding of your risk maturity. Again, going back to how mature is your risk identification process? How mature is your risk mitigation process? Those components of the risk management system need to be at a level of maturity that is commensurate with the risk that you're willing to take on. There should be a shared view of risk and risk appetite. You need to think about what is the likelihood and impact. So the likelihood of an occurrence and the impact should that occurrence happen. And then establish reporting and adjustment parameters so that you're continually monitoring risk. You can react to changes in the risk environment, changes in your control environment, and maintain adherence to a risk appetite. So let's take a look briefly at risk management frameworks, and specifically the components set forth by COSO. COSO is the Committee of Sponsoring Organizations of the Treadway Commission. COSO has been around for quite some time, and they really look at enterprise risk management and internal controls. So as you can see in this diagram, there are 5 key areas containing 20 principles that need to be incorporated into an enterprise risk management framework. The 5 areas being governance and culture, strategy and objective setting, performance, review and revision, information, communication, and reporting. And some of the key principles we've been discussing thus far include defining that desired culture, defining the risk appetite, and reviewing risk and performance. So you can see how these fit into the concept of enterprise risk management. And these, along with the other principles, set forth an effective risk management framework. Also, COSO has put forth this idea of corporate compliance programs and what they need to incorporate. And they define internal control as a process affected by an entity's board of directors, management, and other personnel, designed to provide reasonable assurance regarding the achievement of objectives. It doesn't say here that it's not an absolute assurance that all risk will be eliminated. There needs to be a reasonable assurance. It does set forth what should be included in the compliance program when it comes to a description of the internal control environment. Namely, the compliance program needs to address a set of objectives. That is the operations, reporting, and compliance objectives. Those need to be considered across the various levels of the entity. And the program needs to include a description of the control environment, a risk assessment, and a set of control activities. That is a means for gathering information, and finally a set of monitoring processes and activities. So I think when you think about how your internal control environment is described as part of your AML or your sanctions program, a compliance program, these are things that you need to make sure are addressed within that document and within the actual practices. So let's talk about some key questions stemming from this and the practical application of what we've discussed so far. So first, how important is it to have a well-defined risk appetite statement? And I think a well-defined risk appetite statements is important. And as we talked about in the poll earlier, it's crucial to have the board approve that statement, and we see that many of you do that. The board is certainly accountable for the risk and control framework in the company, and hence also to set the risk appetite for compliance risk. And most regulations will require this sort of thing. What are your thoughts, Edgar?
No, I fully agree. In the case of Aegon, our regulator also requires a risk management framework that includes a clearly defined and well-documented risk management strategy, which includes clearly defined objectives, risk appetite, and tolerance levels. And I personally, I think that speaks already to the next questions about what are the key elements to incorporate into the risk appetite statement. I like the distinction between risk appetite and tolerance, because to your earlier point, a lot of financial institutions won't have appetite for non-compliance to achieve its business objectives, and that clearly also holds true for Aegon. On the other hand, regulations do often allow for a risk-based approach. So in my view, risk tolerance statements help to bridge the gap between that zero appetite statement and the key control environment. So to give an example in the context of economic sanctions, Aegon has no appetite for unlawfully doing business with persons or entities designated by economic sanctions, but then risk tolerance translates that into controls. And examples of those for us are clearing sanctions-related alerts from name screening activities within a certain amount of business days, perform a regular review of system configurations, and having no tolerance for willful circumvention of those controls. So those are a couple of examples of risk tolerance statements. Then the appetite and tolerance form the cornerstone for reporting back to management and the board, because the board has approved those thresholds and need to be informed whenever there are exceptions. And related to that, we have formulated amber and red flags. So for example, an amber flag is an early warning sign. So if a certain percentage of matches is not cleared within that's a certain number of business days, then that is an early warning sign that something may be wrong and needs escalation and reporting. So it's good to monitor those. Red alerts or red flags need immediate attention. So that would include confirmed sanctions matches that are not managed in line with policy requirements.
I think when we've also talk about, do companies and their boards understand the difference in the relationship between business risks and compliance risks? As you mentioned, you're talking about the no tolerance for conducting any sort of unlawful type of business or that. I think one of the things that I found is many times when you're talking about business risk with management, they understand this notion of potential losses, for example, that might be created by entering the business. So from a financial perspective, and whether that's credit losses or in the insurance space, if the claims are outside of what one would expect based upon the type of business and type of policies and so forth. Is there some situation that's occurred that has caused that to exceed what was expected? I think when it comes to those sorts of discussions, and then a discussion around compliance risk, it's one of those things where it's almost hard to quantify compliance risk, because you're really trying to identify what might happen if we run afoul of the regulations. And typically the only way to determine that is to run afoul of the regulation, which is clearly something you don't want to do. So looking at others who may have run afoul that are similarly situated in terms of the type of business, and really working to explain how those risks were encountered by those organizations. This is coming out through enforcement actions, for example, and explaining to the board how, based upon what's in those enforcement actions, certain risks were there, certain controls were not effective. It resulted in certain penalties, and really taking a look at the descriptions that are included in those enforcement actions, particularly those that come out of OFAC. When they talk about what are the aggravating and mitigating factors when arriving at the final penalty assessment. And so being able to explain the statutory maximum and then the base amount of the penalty and then the actual amount of the penalty that was imposed, you can start to relate the costs of non-compliance back to a conversation that might be more familiar to folks that are sitting on a board when they're typically thinking about things from a financial perspective. So I think that also gets to the next question about the most effective way to educate the board and the relationship and the differences. I think that's very critical to be able to bring the discussion on compliance and sanctions risk specifically back to the board in a way that they can easily digest, and to be able to bring that back in terms of potential financial impact is certainly one way. Any thoughts on that particular aspect, Edgar?
Yeah, so I know conceptually non-financial risk heat maps do often have like a different impact scales. So there will be a financial scale, and there will be a regulatory scale that is mapped to that, and then you can tie your risk appetite back to those heat maps. But that's a more theoretical exercise. I think what is important is that boards have diverse backgrounds. Well, often board members are very experienced individuals with diverse backgrounds. So in my experience, they would be familiar with compliance incidents. And there's also laws and regulations that require board members to fulfill their fiduciary duties and exercise proper oversight. So that generally makes board members err on the side of caution. But it's important to not rely on that, and provide necessary training and updates and lesson learned exercises from incidents that happen at other companies, to make sure that they continue to be updated on relevant developments. Of course, a big compliance incident also creates significant awareness, but clearly a more proactive approach is much preferred.
Great. When we think about this practical application and having a risk appetite statement and coming up with that, how does it really relate to the risk assessment process? How do you take the boundaries that have been established in the risk appetite statement and move those forward into a risk assessment?
Yeah, so sanctions risk assessments are an important cornerstone of a risk-based approach towards sanctions. So it's important that risks are first assessed in a thorough and correct manner. And this usually involves assessing inherent and residual risks. So for assessing inherent risk, the OFAC risk matrix is a great resource. It considers factors such as geographies involved, percentage of high-risk customers, history of OFAC actions, etc. FedF is another great resource. It also sets certain requirements, of course, but they also have a lot of resources that financial institutions can learn from. They generally consider the insurance sector as lower risk compared to other types of financial institutions when it comes to sanctions. And key factors there are the lower transaction volumes, long-term nature of the insurance policies, and the complexity of claims processing, which may act as a deterrence. But having said that, sanctions are becoming increasingly complex. I think we will all remember the Russian sanctions when those first came about. Around 50 countries were involved. By now, nearly $300 billion worth of assets have been frozen. And it has shown insurers that it can be a big challenge to navigate these sanctions, especially given that they can change rapidly. So those are all things to take into account while assessing the inherent risk. On the residual risk, it's important to take the control framework into account. And that includes factors such as the frequency of screening, timelines or of updating compliance lists that feed into the system, alert review timelines, and so on. And based on that, you will come to a conclusion on which should be compared regularly with the risk appetite and tolerances that have been set by the board. And this is a continuous process which should be reviewed whenever control weaknesses are identified during assurance activities and whenever compliance incidents occur.
Great. I think one last item on this slide is when we talk about educating the board, given your recent move from the Netherlands to Bermuda, how did you approach that from the perspective of bringing the board up to speed on compliance risk?
Yeah, so we train the board members on personal liability. So the change of the group supervisor has also changed the regulations that apply to the board. So we are providing training on that. So I think that is the key response that we have done to that redomiciliation. But yeah, we also continue to train board members, just like we do with regular staff, on all important compliance topics via our e-learning platform.
Great. Let's move on then in the interest of time, and let's talk about Aegon's approach specifically to risk appetite and risk management.
Yeah, I'll focus more on the risk framework around sanctions, although this first slide is more generic. So we have a group compliance charter. Link is included. It's publicly available, so I can talk freely about it. And the link is included on the slide. It's 29 pages, so I'll just keep it to some highlights. But the charter is board approved and describes how the compliance function is organized at Aegon. It documents our commitment to complying with laws and regulations. It mentions that compliance within Aegon is a second line global function. It documents that compliance is responsible for fostering the integrity of the organization, its clients, employees, and markets in which it operates. It defines the scope of the function, and it also mentions some of the main policies and frameworks that we deploy within the function. So at a more operational level, we have a compliance manual, which describes how we operate. We have an integrity risk appetite statement. So we've talked a fair bit about risk appetite already, but this is the document that we have to cover that topic from a compliance perspective. And we have group policies and standards, and those set requirements for managing compliance risk, both by second line, but also the first line. And that's what I wanted to share on this slide.
Right.
Yeah, so this shows our sanctions compliance framework. And this is also how we ensure that we comply with all the sanctions regimes that apply to us, which can be very complex. This diagram is the risk management cycle, which you will also find in our risk management charter, and it also covers various phases of the risk management cycle, just like you touched upon, Steve, in the COSO framework. I won't go through everything here, but I think some interesting ones that are worth highlighting is that on risk assessments, we are mandated to perform a systemic integrity risk assessment process. So short form is SIRA for that, by the Dutch Central Bank. It assesses all compliance risks, including sanctions risk, in a holistic and consistent manner. And we're now evaluating the approach given the redomiciliation. Group compliance also sets policies and monitors adherence to those policies. But in addition to that, we also have an advice and support function. So we have regional and global calls in which we try to understand local challenges and provide advice. And we have that global call in which we share best practices, support knowledge sharing, and discuss whatever is on our financial crime roadmap. We also have a policy attestation process. So the policies contain key requirements that must be adhered to, and only in exceptional cases a waiver will be granted. Each group policy owner will review submissions from the units in which they will attest to complying with the requirements, and that is an evidence-based process. We perform monitoring reviews, and lastly, we also complete a Wolfsburg questionnaire. This document is mostly aimed at providing assurance around our financial crime program to counterparties. And in that questionnaire, it contains standards set by the Wolfsburg group, and we attest in that questionnaire to what level our units comply with each requirement. So that also gives us as a group function good insight into the local compliance activities. Yeah, I think those are the key ones.
All right, we'll move on then.
So this shows how the sanction screening is set up within Aegon. Of course, this is also an important part of the sanctions risk management activities. It may not come as a surprise, but we use FinScan as our name screening provider. Dow Jones provides the compliance lists, and it's a key requirement in our group sanctions policy that units use this system. FinScan matches our client data with compliance data, and that will create alerts for review by the relevant teams. The client data consists of customers, employees, suppliers, investments, and payments. And the compliance data then consists of sanctions watch lists, PEP lists, adverse media, and internal lists. The system contains a workflow for documenting the review of alerts, and also audit trails, dashboards, and reporting functionality. Those are all essential to us. The system is used locally by financial crime officers and first line, and there's no centralized team clearing alerts, so it's all units have access to it. Maybe just some insights on the size of this operation for Aegon. So we currently have about 70 million records screened on a daily basis. We have well over 100,000 alerts that need to be reviewed annually. And needless to say, that significant resources are spent on operating the system and on managing the alerts. So we're always on the lookout for efficiencies. Then I think on policies and procedures, a key challenge is to create a compliant yet efficient framework. There are clearly a lot of requirements to cover, just to name a few: FATF recommendations, Bank Secrecy Act, key sanctions laws, Wolfsburg principles, and then EU directives. So just to name a few. And so we need to strike a balance between covering what needs to be covered and keeping the framework digestible, which can be a real challenge for financial crime officers in small units who often cover other areas as well. So there's clearly a balance that we need to strike. One way to deal with it is to differentiate policies from standards and procedures, such that requirements are prioritized. In terms of the procedures, the name screening procedures can be challenging for smaller units. System configurations matter. They drive the number of alerts, and working on this can be a daunting task for someone who's less familiar with the topic. We're currently aligning the framework with Bermuda regulations. I've recently looked at the FATF Consolidated Assessment Ratings table that scores effectiveness and technical compliance for all covered jurisdictions. And Bermuda scores very high on technical compliance with FATF recommendations. So that means that their framework covers many of the recommendations, which gives us a high bar to work towards. And we're currently working through that gap analysis. Another challenge on policies and also in practice, frankly, is conflicting regulations. So an important one that comes to mind there is the anti-foreign sanctions law in China. It's a Chinese law that counters foreign sanctions targeting Chinese persons. And this puts Chinese businesses that need to adhere to foreign sanctions into a difficult position. And unfortunately, there's no easy way out, but instances of such conflicting regulations need to be escalated to group compliance. And then based on legal consultation and risk assessment, a strategy can be devised. I unfortunately can't share more on this topic. Just a few notes on the sanction regimes that we apply to globally. So it's actually a fairly long list. So we apply UN, US, EU, UK, Bermuda, and Dutch sanction regime globally. And reason for that is mainly related to our company's setup. So we have that dual listing that I mentioned earlier in the US and the EU. We also have significant presence in both areas. We have a large unit in the UK. We're domiciled in Bermuda. We have significant counterparties in the Netherlands. And the UN is a globally recognized sanctions regime. So those are the reasons for the long list. We may screen against other jurisdictions as well, but we consider those more as leading indicators in case one of our names is on one of the other jurisdiction sanctions lists.
So Edgar, interesting, as a global organization, and the multitude of regulatory regimes that you need to adhere to, and as you mentioned, the conflicting regulatory regimes. But when you have a situation where you've got consistency in the sense that sanction screening needs to happen, but maybe there's a difference in degree or approach, leaving out for a moment the conflicting regulations perspective. What's Aegon's approach? Is it one to say, here's a minimum standard that everybody needs to adhere to, and then there are regionally or geographically unique requirements that need to be taken into account, or is there sort of lowest common denominator? You take the most restrictive stance and apply it globally. What's Aegon's approach from that perspective when it comes to policies and procedures?
Yeah, so the lowest common denominator is the one I mentioned earlier. So we apply that list of sanctions regime that I mentioned globally, and all businesses adhere to that. It's just that whenever there are conflicts, whenever conflicts arise, we need to see how to deal with that. And like I said, it's important to then involve legal and perform a good risk assessment to devise that strategy.
When it comes to things like the configurations, are those configurations in terms of the matching different in different jurisdictions? And how do you make sure that those configurations are reasonable given the particular risks in a location? Is that left to each individual area, or is there a standard that's applied from a global perspective?
Yeah, so we have a baseline configuration on that is applied. It is the case that some countries have a lot of common names, leading to very high alert rates if those baseline configurations are applied. So there has been work over time to work with each unit to fine-tune the configurations to bring it to a more to get more relevant alerts. And but any changes in those match strings, that's basically another word for the configurations, will come to group compliance for review, and that is how we maintain oversight on those configurations.
So let's take a little bit of time now to talk about data quality and payment screening, and two topics that are definitely not mutually exclusive. So we've talked about where the screening program incorporates certain data elements, and let's talk about generally where the data is resident. So first, policy issuance and maintenance, and that data is typically contained on an underwriting system. Second, data regarding premiums due and premiums collected could be on a second system. And the third system could have claims submitted and paid. And the question is all the relevant data on each of the systems or does data need to be brought together to have an effective screening program? Again, we can see information in some recent enforcement action where claims were paid, but the information regarding the policyholder was on the underwriting system, and the policyholder became a sanctioned individual, but the claim was paid because the information on the claims payment was not part of the screening. So that is something that we need to think about as to where this data is resident, to make sure that we're bringing it all together in a way that allows for all of the risks to be identified and potential hits to be identified. So thinking about this, do we need to have all of the information on the policyholder, the claims, and the premiums all brought together into some sort of golden source, or do we need to make sure there's consistency of data across the system so that we can make a good screening conclusion based upon consistent data? So these are things that we need to be thinking about in terms of understanding where your data is and how you apply that data and apply screening to that data. So in terms of payments, we need to think about payments made and payments received, premium payments made to the insurer, and claims payments made to a policyholder or beneficiary. We need to think about how those payments are made and received. Are new technologies involved? Is the legacy technology that's currently used able to handle new payment methods? And do we understand what data is available and what format? And perhaps most importantly, is the screening system configured to handle new payment types and technologies? In terms of optimizing the matching process, it's important to leverage richer payment data that comes from new payment formats. The new payment data can provide for the ability to slice and dice data and look for secondary identifiers to use in the matching process. The matching algorithms can then flag alerts by different types and patterns to aid in the resolution process. And all of the data that's available in the new payment formats can be used to reduce reliance on name-only or free text searches, and thereby reducing false positives. And of course, as we mentioned, incorporating new data such as geolocation data to aid in the generation and resolution of alerts. So let's talk about some key questions on data quality and payment screening. And poor data has a tremendous impact on screening efficiency. And Edgar, what are some of your thoughts on data quality in this area?
Yeah, so I mean, data quality is extremely important. So more accurate and complete data leads to lower alert rates. Incomplete data leads to higher alert rates. Incorrect data leads to incorrect conclusions. That's also important. So it's really garbage in, garbage out that really applies in this case. Like I mentioned earlier, we have common names in certain jurisdictions. So for those especially, secondary identifiers are crucial to bring the alert rate down. So it then becomes important, for example, to know the date of birth of the person with that common name, such that you can compare that with the date of birth of the customer that you have in your records. And there are also other identifiers like the location, address, etc., that you can use to evaluate whether it's the same person. And I think another thing I want to say is that when it comes to data quality, it's important that both the data that feeds into the system from by the financial institution is of good quality, but also the compliance list data is required to be of good quality. If a compliance list provider provides mentions that someone with a common name is sanctioned but doesn't provide any secondary identifiers, then it also becomes difficult to recognize which person is being targeted. So high alert rates leads to challenges with alert closure timelines. It impacts resources, and perhaps most importantly, leads to complacency. So if there are many false positives, it may lead to false negatives due to staff complacency. And this is also where the risk can materialize. So I think these are important factors to take into account when thinking about data quality. And maybe my last comment on this is that regulators also require stringent quality standards, and especially when it comes to payment transactions. And I know that the ISO 2022 has been introduced, which also raises the bar further. So think these are a couple of considerations that I wanted to share.
I appreciate that, and I think it's really important to bring out this notion on the various formats for payments that are out there, and certainly difficulties in integration, not only into your systems overall, but into your screening systems. It's critically important that you consider that, because the new formats, like you mentioned, the ISO 2022 is one where it's certainly a richer, structured set of data versus an unstructured set where you're looking across free text fields and so forth, as we mentioned earlier. It provides the opportunity for enhanced screening, but it also provides some regulatory risks, because if you're getting that information in that format but you're not utilizing it, then the common question from the regulators is going to be, why aren't you utilizing it? Great, so let's talk a little bit now about the impact of data quality on screening, and some of the things that you mentioned already about the match configurations and the lists and the high-level logic and so forth. If there's any other commentary that you want to make with respect to data quality?
Yeah, so I think it's important to continue to review system configurations. It's not a one-time effort. High-level logic that we apply as we work through this is that you need to be aware of the list that you screen against. I mean, this sounds very logical, but it's very important not to screen against irrelevant lists, because you will get irrelevant hits. And so that is low-hanging fruit in my opinion. Then it's important to risk rate the lists that you do screen against, and it is you can then apply looser match strings, resulting in higher alert rates to high-risk lists, and vice versa. And then lastly, you have to diligently enhance data over time. So don't screen against unnecessary names. I mean, there can be duplicates in the system. There can be irrelevant parties entered into the system based on the new business forms that have been reviewed. And so that is a large effort. It requires budget and technology enhancements. So that is really a multi-year task. The good thing is, if you reduce name counts, that will lead to cost savings as well. So directly through licensing costs, because often licensing costs are related to name counts, but fewer alerts also leads to reduced resource requirements.
Great. So when we think about the screening considerations and addressing the challenges of payment screening and dodging roadblocks and outsmarting high-risk individuals, entities, and transactions, what are your thoughts here, Edgar?
Yeah, so I think for insurers, payment screening tends to be lower risk given the lower volumes, but it still needs to be a compliant process. So higher risk pockets for insurers are payments from and to third parties if they haven't been screened before, and international transfers, and then especially to high-risk jurisdictions are higher risk. So within Aegon, we have provided guidance on how to determine the level of screening per payment category. And this guidance takes compensating controls, such as daily coverage of screening of those names into account. A de minimis threshold for small value payments can also be considered. But in principle, every payment needs to be screened. So it doesn't matter which payment type it is. But it is important to consider all payment types, such that you are complete in your screening. So many financial institutions will accept checks, ACH, EFTs, online payments, and mobile banking apps. So just a completeness check to make sure you've covered off everything is very important. And then I think lastly, I see here a bullet on real-time screening. So real-time screening is required for time-sensitive transactions, and that's usually the case for banks, but insurance companies also have products that have straight-through processing, and that is where real-time screening could come in for us.
Great. So I think, in summary, what we've talked about today is that compliance risk management frameworks are really an essential part of effective compliance programs. The need for a well-defined risk appetite statement certainly is a key component of that. The ability to measure and monitor against that risk appetite is also critical. And it can't be understated that data and its availability and quality can make or break one's compliance program. Data quality cannot be understated, the importance cannot be understated, and then certainly that the changing payments landscape will impact your payment screening activities. So I think all of these things you need to keep in mind, and it's all part of a living and breathing compliance program. And I think that if you take these into account, it can really work to help enhance your program.